In the previous video, we learned about candlestick patterns and built a solid foundation for understanding price action. Before we get into the main content of this video, I'd like to briefly talk about three key concepts: Fibonacci levels, the RSI indicator, and RSI divergence. These are essential tools for accurately analyzing harmonic patterns. Fibonacci levels are not just numbers. They form the mathematical foundation behind every harmonic structure. If you don't use these levels and the RSI correctly, the patterns alone won't have much meaning. So before we begin, let's quickly answer these three questions. What is Fibonacci? Which levels will we be using? What is RSI? And how can it be used as a filtering tool? If you're ready, let's get started. If you'd like to see more technical analysis and educational content like this, so you can improve your skills and follow the markets with greater confidence, please don't forget to like this video and subscribe to the channel. What is Fibonacci? What exactly is Fibonacci, and why do traders care so much about it? Fibonacci refers to a famous number sequence where each number is the sum of the two before it: 0, 1, 1, 2, 3, 5, 8, 13, and so on. While it might sound like just a math concept, this sequence reveals a series of ratios that appear everywhere: in nature, in architecture, and yes, in the financial markets. The most important of these is the golden ratio, or 0.618. This number and its related percentages, like 38.2%, 50%, 61.8%, and 78.6%, are used to identify where price is likely to pause, reverse, or continue. In trading, these ratios help us understand how far a price might retrace before continuing its trend, or where potential turning points might be. They form the very foundation of harmonic patterns, which we'll get into shortly. But first, let's take a closer look at these key Fibonacci ratios and why they matter. Now, let's take a closer look at how the structure we just discussed is applied step by step on a real chart and turn the theory into practice. To select the Fibonacci tool, click on the menu on the left side of the screen. Then, on the right panel that appears, you'll see the Fibonacci tools we'll be using. On the screen, you can see the key Fibonacci levels we'll be using for harmonic analysis. At this point, feel free to pause the video and manually enter these levels into your TradingView settings to save them for future use. This step is important to ensure you're working with the correct ratios when drawing and validating harmonic patterns. What is RSI and what is divergence? RSI, or Relative Strength Index, is a momentum indicator that shows whether an asset is overbought or oversold within a specific time frame. It ranges between 0 and 100, with readings above 70 typically considered overbought and below 30 considered oversold. So, what is divergence? Divergence occurs when there's a disagreement between price movement and a technical indicator, in this case, the RSI. In other words, the price forms a new high or low, but the RSI fails to confirm it. This signals that the current trend may be losing strength and a potential reversal could be approaching. Bullish divergence, positive divergence. Price makes a lower low, but RSI makes a higher low. This indicates weakening selling pressure and suggests a potential upward reversal. Bearish divergence, negative divergence. Price makes a higher high, but RSI makes a lower high. This shows declining buying momentum and signals a possible downward reversal. For example, to add the RSI indicator, simply type RSI into the indicator search bar at the top of the screen and select Relative Strength Index from the list. Then, adjust the settings as shown on the screen to match your trading style and save the configuration for future use. What is harmonic trading? Harmonic trading is a form of technical analysis that uses precise price patterns based on Fibonacci ratios to pinpoint potential market turning points. What sets harmonic patterns apart is their reliance on exact Fibonacci measurements, rather than subjective trend lines or loosely defined shapes. Main harmonic pattern. The most widely used harmonic patterns in the markets, known for producing strong and reliable signals, are Gartley, bat, butterfly, crab, deep crab, shark, and Cypher. To draw harmonic patterns, start by clicking on the tool menu indicated by the arrow on the screen. Then, use the tools I've circled on the right side of the interface to begin building the pattern step by step. These tools are essential for accurately plotting the XABCD structure in harmonic analysis. What is the Gartley pattern? The Gartley pattern is one of the most fundamental and well-known harmonic patterns used in technical analysis. It was first identified in 1935 by H.M. Gartley, which is why it bears his name. This pattern typically forms during a market correction and suggests that the price may soon resume its movement in the direction of the prevailing trend. It is a 5-point structure labeled XABCD, and it is based on Fibonacci ratios. Gartley harmonic pattern rules. The first move in a harmonic pattern is a straight line from point X to point A. Point B must touch the 61.8% retracement level of the XA leg, even if it's only with a wick. However, it must not reach the 78.6% retracement level, not even with a wick. Point C must, even if only with a wick, definitely touch the 38.2% retracement level of the AB leg. However, it must not, even with a wick, touch the 88.6% retracement level. Point D is the 127.2% Fibonacci extension level of the AB leg. Entry strategy, Gartley pattern. When it comes to entering a trade based on the Gartley pattern, there are two common approaches. 1. Immediate entry approach. Once point D is completed, a position is opened without waiting for any additional confirmation. This method is favored by aggressive traders who trust the structure of the pattern itself. 2. Confirmation-based entry. After point D is reached, price action is carefully observed. The entry decision is based on additional signals, such as candlestick formations, momentum indicators, or rejection wicks. This method is preferred by more conservative or risk-aware traders. Gartley pattern, target and stop levels. Target levels. First target, the 38.2% Fibonacci retracement of the AD leg. Second target, the 61.8% Fibonacci retracement of the AD leg. Stop level. Once the trade is entered, the stop loss is typically placed just below the 138.2% Fibonacci extension level of the AD leg. This level marks the invalidation point of the pattern. If price reaches this zone, the pattern is considered broken and the trade should be exited. Gartley Pattern Perfect Rules. The first move in a harmonic pattern is a straight line from point X to point A. Point B must touch the 61.8% Fibonacci retracement level of the XA leg, even if only with a wick, but it must not touch the 78.6% level, not even with a wick. Point C must touch the 61.8% Fibonacci retracement level of the AB leg, even if only with a wick, but it must not touch the 88.6% level, not even with a wick. Point D is located at the 127.2% Fibonacci extension level of the AB leg. Entry and filtering methods in the Gartley pattern. The most important rule in the Gartley pattern is this: never enter a trade before price reaches point D. However, even after price hits the expected D level, we don't rush into a position. Instead, we apply a set of filtering techniques to minimize risk and increase confirmation. Here are the key filters I use. 1. Identifying the PRZ, potential reversal zone. 2. Candlestick pattern analysis. 3. Support resistance confluence. 4. RSI divergence. 1. Identifying the PRZ, potential reversal zone. First, I draw a Fibonacci from point A to B and mark the minus 0.272 level with a horizontal line. Then, I do the same and mark the 0.786 level. The area between these two lines becomes my PRZ, potential reversal zone, where I expect the market to potentially reverse. 2. Candlestick pattern analysis. I check for reversal candlestick patterns such as pin bars, engulfing candles, or doji formations within the PRZ. These are early clues of a possible price reversal. 3. Support resistance confluence. I analyze whether point D aligns with a strong support or resistance zone. This adds extra confirmation and increases the probability of a valid reversal. 4. RSI divergence. When price reaches point D, I also check the RSI, Relative Strength Index. If there's an overbought or oversold signal, and especially if there's RSI divergence, that strongly reinforces the reversal potential of the pattern. Now, let's apply the filtering methods we've just learned by analyzing a real example step by step. Now, I'm bringing a bullish Gartley pattern example to your screen, formed with real market data. And now, we're looking at a bearish Gartley pattern example, also formed with real market data. In today's video, we covered the essential concepts of Fibonacci and RSI needed to understand harmonic patterns. Then, we took a deep dive into our first harmonic structure, the Gartley pattern. This knowledge will serve as a strong foundation for the other harmonic patterns we'll explore in upcoming videos, starting with the Cypher pattern in the next episode. If you found the video helpful, don't forget to like it and subscribe to my channel if you haven't already. Feel free to share your questions and thoughts in the comments to help improve future content.